Hello students, welcome to my class. This is Professor Vincent Osaya, and this is the presentation of Chapter 8, Receivables. So let's take a look at the overview of Chapter 8. As we discussed previously, starting from Chapter 7, we indicated that subsequent chapters are going to zero in on one of the elements of a financial statement. So in Chapter 7, we talked about cash in detail, and now in Chapter 8, we are going to talk about receivables. So from that standpoint, our objective in this chapter is to learn the accounting rules or accounting principles relating to accounts receivable, how to apply those accounting principles in order for us to prepare accurate and complete balance sheet. Then we eventually will communicate the information in form of financial statements to different decision makers, be it internal or external users. Then ultimately we analyze the information and figure out what the numbers actually means. So moving forward, let's talk about receivables. In the United States of America, credit facility is a big deal. What do I mean by that? A lot of us, individuals and businesses, we deal with a lot of credit facilities. So even students have credit card. But in actuality, what is the benefit and which parties are involved when we talk about credit facilities? Three parties are usually involved. On a personal basis, you and I will be the consumer. We use our Visa, MasterCard. The retailer is the second party, and the Visa company or MasterCard is the third party. The three parties have something to benefit from this credit facility. For you and I, we are able to buy and enjoy what we cannot afford right now. For the retailer, that is the company selling us stuff, they are able to generate what? More sales, right, than they would have been able to generate ordinarily. More sales usually result in more net income or net profit, everything being equal. So that is their benefit. For the Visa, MasterCard, their benefit is they charge the retailer X amount of money for making that provision available to the consumers. So everybody benefits from that relationship. Another thing that I want to share with you that you probably might not be you might not be aware of is the fact that credit facilities is almost non-existent in other parts of the world. Here in the United States, people have credit cards. There are a lot of parts of the world whereby the only people that get credit cards are the VIPs, like Michael Jordan or Oprah Winfrey. Regular folks don't get credit cards. As a matter of fact, in a lot of countries, there is no mortgage facility. So if you graduate from the university, you get married, guess what? You and your spouse have to work for 5 years and save money and buy a piece of land. Then you work hard for another 5 years and save money and get the foundation of the house done. Then you work very hard for another 5 years and save money and build up the house to the roof level. Then you work hard for another 5 years and save money and buy the materials to do your roof and get the interior done. So by the time you are done, what are you talking about? Some people it takes them average of 25 years to build their house. But the benefit of that is by the time you are done, the house is free and clear, right? But in the United States, you can graduate from college 2-3 years, you can get a mortgage, right, and enjoy your house, right? And most of us say, well, that is my house. But actually, it is not. If you miss 2 or 3 payments, we quickly find out whose house it is, right? So, again, the most important thing here is in the United States, credit facilities is a big part of the United States economy. Now, let's take a look at, having completed that overview, let's take a look at some of the objectives. Here in this chapter, we are going to talk about different types of receivables. We are going to talk about how to write off accounts that might not be, that the company might not be able to collect. We are going to talk about how to apply provision for uncollectible accounts. We are going to talk about how to compute interest relative to the notes receivable of the company, and we're also going to talk about some ratios in connection with how to analyze the information and really figure out what the numbers actually means. Now, let's take a look at the first objective. The first objective. We are going to define and explain the common types of receivables and generalized sales on credit, credit card sales, and debit card sales. Now, question is, what is a receivable? If you take a look at the title of this chapter, we said receivables, plural. So here we are talking about multiple receivables or different types of receivables, even though our main focus in this chapter is going to be accounts receivable, but there are different types of receivables. So from the outset, what is a receivable? We said it is a right to receive cash in the future from a current transaction. So anytime we say receivable, that means that is the money that we are likely to receive in the future. Receivable, accounts receivable, notes receivable, note loan receivable, so on and so forth. So here we have three types of receivables: accounts receivable, notes receivable, and other receivables. So the first one is accounts receivable. We also call it trade receivable. I want you to know this. Accounts receivable result only from selling goods to customers on credit or providing services to customers on credit. So let me repeat that. Or no. For example, if one of your employees is having a hard time and your employee say, you know what, boss, I need $1,000 loan, and the company gives $1,000 loan to the company needs to record it and keep track of it, but the company cannot consider that is a receivable because the company is going to receive the $1,000 in the future, but the company is not going to keep track of it in an account called accounts receivable, because accounts receivable is set aside, or is an account that we use to keep track of only goods sold to customers on credit, or when we provide services to customers on credit. As you know, every company does one of two things. You are either selling goods or you are providing services. So accounts receivable is specifically defined as such. Usually, most companies will collect their accounts receivable in 30 to 60 days. Moving along, let's take a look at the second one, that is notes receivable. We said that the note receivable is a promissory note. So for example, we sell $5,000 worth of goods to a customer, and the customer is a new customer. We really don't know the customer, we are not comfortable with the customer. So instead of the customer just promising to pay in 30 to 60 days, we ask the customer to put his promise in writing. So the customer put the promise in writing and said, I, XYZ, promise to pay you $5,000 in 6 months or 9 months, however the case might be, with such an interest. And the customer gives us a note. That note, we receive the note, that is, we record it in an account called notes receivable. Versus accounts receivable. Accounts receivable is an oral promise to pay. So the customer is not putting anything in writing. The customer just promised to pay us in 60 days. All right? So that is the difference between accounts receivable and notes receivable. One is oral promise. Notes receivable is a written promise to pay eventually. Now, usually notes receivable consists of principal and interest. Now let's take a look at the third type of receivable. We call these other receivables. So there are other receivables that we need to also recognize or record or report in the balance sheet. Some examples are dividends receivable, taxes receivable, interest receivable, so on and so forth. Some of them could be short-term, some of them could be long-term. You know, short-term meaning we expect to receive it within 12 months or within the operating cycle of the company, whichever is longer. We deal with this issue in the previous chapter. And of course, long-term will be beyond that time frame. Now, moving along, let's take a look at how we record sales on credit. I want you to take a look at this. It said on credit. Another word for on credit is what? On account. So we sell something on credit or on account. These two terms are used interchangeably. So let's take a look at the example that we have here. On August 8th, Smart Touch performs $5,000 in services to Brown on account or on credit, and sell $10,000 of inventory on account to Smith. So we have two transactions here. The company sold performed $5,000 worth of services to one party, and sold $10,000 worth of inventory to another party. So let's take a look at how we record or recognize again, remember we talked about the difference between recording and reporting. We record in the journal ledger and we report ultimately the information in the financial statement. So let's take a look at the example that we have here. So for the $5,000 worth of services that we provided on account to Mr. Brown, on account meaning the customer did not pay us. So we keep track of that receivable in an account called what? Accounts receivable. So we debit accounts receivable for 5,000. Accounts receivable, as you know, is an asset. When an asset goes up, we debit. So in this case, we debit accounts receivable for 5,000, and we credit service revenue for $5,000. Moving along, we also provide $10,000, or we also sold $10,000 worth of inventory to another customer on credit. So we debit accounts receivable for 10,000 and we credit sales revenue for 10,000. I want you to take a look at the two accounts that we credited. The first one we credit what? Service revenue, because we provided services. So we keep track of that in an account called service revenue. But the second account that we credited was what? Sales revenue. Now, of course, we are omitting one entry here. Which entry is that? Remember, when we are using perpetual inventory system, we make two journal entries, right? When we sell goods. And the other journal entry is to recognize cost of goods sold and reduce the inventory. Then we are ignoring that at this point. So moving along, let's take a look at using an accounts receivable subsidiary ledger. Now, what does this mean? Now, you realize in a few weeks, we talked about what? Different types of accounting records. Number one, we said that the original books, or the first book of accounting records is what? The journal, right? So, we call it general journal. So every transaction has to be recorded first of all in the journal. Hence, we call it the first book of original entry. Now, we said that we also have other types of books that we use to record transactions. The second one is what? The ledger. And we said that the ledger have what? Each page is devoted to what? Each account. Now, we talked about the difference between those two records. We said for the ledger, it helps us to determine the balance of each account. Now, for classroom purposes, because we don't have an opportunity to flip pages like we do in real life, we said we have a T account setup, and we say each T account is a representative of a page in the ledger. So guess what happened? In real life, if we were to have a ledger and the ledger consists of different accounts, these are cash, accounts receivable, accounts payable, rent, expense, so on and so forth. Now guess what? If we have 1,000 customers that buy goods on credit, we will have 1,000 accounts receivable for each customer in the general ledger. So guess what? That makes managing the general ledger very complex, because you have 1,000 individual customers account in the ledger. So to make the management of this book more manageable, take a look at what we do. We set aside another book. We call this subsidiary accounts receivable, and here we have one customer A, customer B, customer C, customer D. So we have this book specifically set up for individual customers' accounts. Now, we call this general ledger, and we call this accounts receivable subsidiary ledger. Now, what is the benefit of this? Instead of having 1,000 accounts receivable in the general ledger, we now have 1,000 customers account in the accounts receivable subsidiary ledger. This book is assisting this book, but we still need one accounts receivable in the general ledger, and this accounts receivable is a summary of all the accounts in the accounts receivable subsidiary ledger. So if all the customers owe us 1,000, 1,000, 1,000, 1,000 for a total of 4,000, the accounts receivable in the general ledger will have 4,000. So that is what we mean by using an accounts receivable subsidiary ledger. So that is the conclusion of part 1 of chapter 8 presentation, chapter 8 receivables.